Welcome back. Now, load shedding and interest rates affected various sectors in 2023, and the property sector was no exception. Evidence of this is various REITs citing unending blackouts and high rates as one of the main challenges that weighed. Looking ahead, the possibility of rate cuts mid-2024 and an easing in load shedding is expected to boost investment and skyrocket demand in the sector. Erwin Rode, who is MD of Rode and Associates, joins me now for outlook on the property market in 2024. Erwin, and pleasure. Good afternoon to you. Hi, Erwin. Can you hear me?
Yes, I can hear you.
How are you?
You are faint, but I can hear you.
Okay. I think we'll just try to solve that with our technicians. I'm just keen to maybe reflect on the property sector in 2023, looking both at residential and commercial property. How would you characterize what we saw in our previous year?
Well, the performance of the property market depends very much, of course, on the performance of the economy, stupid. It's as simple as that. But there's a second factor, and that is, of course, the overhang, the surplus, the vacancies. So if you have a stagnating economy, plus you've got very high vacancies, as is the case with, for instance, office buildings, then the prospects for rental growth from the landlord's perspective, of course, are not very good. So the office market has performed very poorly over the past few years because of this overhang. And given the poor prospects for the SA economy, a stagnating economy, and the current overhang, which is about 15% on average for grades A and B, then obviously the prospects are not very good for growth in the office market. Having said that, I think the rental market, or the rentals, have bottomed in nominal terms, but in the real terms, and that's very important. In real terms, we're expecting rentals will keep on declining for quite a number of years. So over the next couple of years, office buildings won't be a very good investment. That's virtually a given. The industrial property market is different. The industrial property market hasn't got this big overhang of space because the industrial property market is less of a speculative market. Most industrial properties are built on demand, so you've got less of a speculative element there. And as a result, the vacancies of the industrial market are much lower, at about 5% thereabouts. On average, and as a result, the prospects for the industrial market is not as poor. But even so, rentals are growing at a rate that is below the growth rate in building costs. So even though, relatively speaking, industrial rentals are doing well, we must remember that in real terms, in other words, looking at it from the viewpoint of a developer who is thinking of putting up a new industrial building, the rentals are declining in real terms, which means it becomes more and more difficult to make your viability study work.
I'm also keen to touch on residential property. It's a bit of an opaque one that's also very difficult. And I'm wondering if it's as speculative, as what we might see with the office here, and what might be driving residential property prices in South Africa right now.
Right, there are two important drivers of the residential market, and both relate to viability. Affordability really is the right word, and affordability is constituted of the following elements. Number one, interest rates. Obviously, the higher the interest rates, the higher your installment, and therefore the less viable your renting becomes, or your owning becomes, by the way. And then the second element is growth in the economy, which is a proxy for the growth in net incomes. And as unemployment rises, as increases in incomes are less than the inflation rate, for instance, then of course, all other things being equal, then housing becomes less affordable. And both these factors at the moment are at play. We've got an economy that is stagnating, so therefore incomes of households are shrinking. In real terms, most certainly. In nominal terms, maybe too, in many cases. And secondly, of course, the high unemployment, and of course, interest rates are still very, very high. So these two combined makes for poor prospects for the economy, although optimists will tell you that we all hope that that interest rates will start declining later this year. It's the most difficult thing to forecast is interest rates, because it depends not only on your own economy, but also what's happening in places like the US of A, for instance. But let's hope that interest rates will at least peak at this year sometime. But I don't expect interest rates to come tumbling down thereafter. So I think buyers out there, potential buyers, should consider that for the next few years, property prices in real terms are not going to grow. So from purely an investment point of view, and I stress it, from an investment point of view, not from a social point of view, but from an investment point of view, therefore, it's just about all properties at the moment are not very good investments. Possible exceptions might be developments for students, because that is a growing segment, but affordability there is also going to play a role sooner or later.
I'm also keen to get your thoughts on retail space. In my mind, Erwin, we see a lot of retail, spaces in South Africa, and I'm wondering if we would ever get to a point of oversupply there, where there's just too many shopping centres, too many shopping malls, then what the South African can handle, considering that, like you've mentioned, household incomes, just aren't growing at a realistic level.
Yeah, we don't have hard statistics on, well, we do have some statistics. We know that the vacancies in our big malls especially are increasing again. They came down after the COVID-19 scare, but they started rising again. Not by much, but they're rising again. And that reflects, to me, reflects an underlying malaise out there of households not earning enough in real terms, or growing their incomes not growing in real terms. And as a result, you can say a good proxy for oversupply is the vacancies in malls. And as I said, the vacancies are slightly increasing again. So as a generalization, I think one could state that in the metropolitan areas especially, there is an oversupply of prime retail space, without a doubt. But of course, the micro locations there would differ. In some areas, a shopping center may still be doing very good because it hasn't got as much competition as the one 15 kilometers away, that sort of thing. As a result of this phenomenon, you'll find that there are quite a number of developers which over the past years have been exploiting the platteland market, the countryside. We don't have this severe oversupply as yet. So what these guys then do is they develop a larger shopping center just outside a largest town, and then of course the town itself dies from a retail point of view. It's a terrible situation, really. And that's typically South Africa's model, the way we do it. I understand in some European countries it's not like that. The powers that be try to defend the midtown shopping streets, as the Brits call it, the high streets.
Well, unfortunately, it's all we have time for today. Thank you for these very, insightful insights. And I'm sure we'll keep talking throughout the course of the year. That was Erwin Rode. He is MD of Rode and Associates.